The temptation when you're quite young is to think, well, if I got it right the first time, it must be an even better bargain the second time. And so you try and find some more cash and put it into the one which has fallen the most. And this also works in a certain sense in the opposite direction. So you put 10% of your money into a stock and it rises 10 or 20%, and you're feeling absolutely fantastic about yourself because you made a profit of 10 or 20% in 6 months and you've only got 2% or something on a bank deposit. So you rush to sell. The next day, the share price is 3% higher, and a month later, it's 5% higher, and 2 months later, it's 10% higher. And you're thinking, what was I doing? Why did I sell when I could have got so much more? And maybe you're looking 5 years later, it's doubled or tripled or quadrupled.
Risk by itself means probably nothing. It's about how much risk can you accept within a month, 6 months, 1 year, 10 years, etc. Because that really changes everything.
The dream of every asset allocator is to find the perfect portfolio, which is where your different asset classes are sufficiently uncorrelated that you have an upwards only slope, one way only, with very, very little volatility, very, very little downside.
Why aren't the masses financially educated? Is this by design or?
But I finally solved the problem. I'm going to share this with all your listeners and viewers, and it's a very important lesson that everyone can learn from me and save yourself 18 years of pain. And it's this: when you invest or when you want to invest in something, never invest the amount you would like to.
We are at all-time high almost in everything, like all-time high in stocks, all-time high in debt, all-time high in social help from government.
He put on the table in front of me a bar of chocolate, Cadbury's, a bar of chocolate that cost sixpence in those days, six old pence. Obviously, an old pence is not a new pence that we have today. And he also put down a £1 note. And he said to me in front of his friends, Clive, do you want the £1 note or the sixpenny bar of chocolate?
So if there is no store of value, essentially I can't plan for the future.
At the end of the day, people are getting richer as the government gets poorer. And we know that ever since the beginning of time, and this is not just in this century, it's the centuries gone by as well, and right back to the Roman times, no matter who was in power, they always had a habit of overspending, whether it be on wars or in more modern times on social security, on funding people's unemployment and things like that.
We try to solve optimization problems across more dimensions, and we want to maximize returns, but we want also to minimize risk.
We're in a world where that debt cannot be repaid. There's no chance, there's nothing which can be done, no amount of adjusting the budgets and so forth, which will allow that debt to be repaid. So if it cannot be repaid, the only thing they can hope for is to keep borrowing from Peter to pay Paul. And when that fails, if they can't borrow from Peter to pay Paul because Peter says, sorry, I won't lend you any more to the government, then their plan B will be to monetize that debt by allowing the central bank to buy the debt by printing money. And at that point, a lot of money comes into existence.
I thought I have everything under control, but it was almost a disaster because I realized that book gave me only 10%, kind of. 90% was only emotions. And that was something I couldn't read, basically. I couldn't train by reading books.
So we don't know for sure where that leads, but there's certainly going to be a lot more efficiency everywhere. And it might mean that companies which previously could produce very cheaply because of their low labor costs are now facing competition from even lower labor costs because the labor now is machines.
If I wanted to add crypto, and I know that there are many cryptos, but let's use the term as general as possible. And I wanted to be exposed at least to these new technologies coming. And how do I find the value?
A very simple example, which most people have figured out, is to buy your own home if you can. And if you can buy it with borrowed money, even better. So the sooner you buy it, the better.
Well, the debt can never be paid. Small countries might default, but the bigger economies will not maybe default, then the only way is inflation, then my problem is solved. Just close your eyes and throw some money around on companies because it will anyway go up.
Everybody else on the planet has heard the same news as you, and everybody on the planet is likely to act in the same way as you. So, what does that mean? It means you're part of the crowd. You're doing what everybody else is doing. You're running like the lemmings, and that's something which I've learned to avoid. And obviously, one of the ways to avoid it is by not having so much in anything that it scares me.
What are the few things you tell to people, regardless of their educational background?
And now you suddenly find your travel abilities limited. And then they might go further and say, well, you voted for the wrong political party. So, or you made a post on social media that we didn't like. And now we're going to restrict your ability to do something via your CBDC wallet.
Clive, thanks a lot for accepting my invitation.
Thank you, Elvis.
I read your posts and I really find them very informative. And then I decided it will be good to have you on my channel. I would start by giving you the chance to introduce yourself. What have you done, and then how it comes that you have this knowledge about economy, stock market, and all these financial assets.
Sure. So my career in investment started 50 years ago, and I've been investing money in the stock market and all kinds of other things ever since then. My first exposure to equities in particular came about 6 years before that, or maybe 4 years before that, when I was about 14 years old, and I visited my granddad in hospital. And he was probably in his final days, but he had a little exercise book in which he kept the names of 4 or 5 stocks that he held, UK stocks they were, and against each stock. So there was one page a day, and each day he'd write down the name of these 4 or 5 stocks, how many shares he held, the price, multiply the number of shares by the price to the right-hand side of the page with the value of that holding. Then he'd add up the column and get to the grand total. And at the age of 14, I was absolutely fascinated that not only did the price change, the value of each holding would change, and then the grand total would change. So we had a page a day, and I could go through these pages and see that the grand total was different every day. And I became absolutely fascinated by the concept that, and of course he was boasting a little bit because stocks were going up, that he was making money in this way. And I was determined that at some point, when I reached old enough, which was 18 years old, I'd start investing. And that's exactly what I did almost as soon as I could after my 18th birthday. And yeah, I've been investing ever since. My career was wealth management, looking after high net worth individuals, broadly speaking, or almost always in Switzerland. It was not totally in Switzerland, but almost always in Switzerland, in Swiss private banks.
Can we say that that episode was really seeding something inside you already, at 14 years old? That
Yes, exactly. I mean, I think there were two seeds. One was in respect to the stock market, and another one was many, many years before that with respect to gold, but very slowly. I mean, I was probably about 6 years old when my granddad played his first trick on me in front of his friends. We were at his house, and he'd brought his friends round, and he put on the table in front of me a bar of chocolate, Cadbury's, a bar of chocolate that cost sixpence in those days, 6 old pence. Obviously, an old pence is not a new pence that we have today. And he also put down a £1 note. And he said to me in front of his friends, Clive, do you want the £1 note or the sixpenny bar of chocolate? Well, being 6 years old, I took the chocolate. And all his friends burst out laughing because there were 240 pennies in a pound back then, and I could have bought 40 bars of chocolate if I'd taken the £1 note. So they all found that terribly amusing. And a year later, he tried the same trick on me, but this time he put down the bar of chocolate, the £1 note, and the a gold sovereign. A gold sovereign is a British £1 coin. Wasn't in circulation in the 1960s, but obviously some people had one of these. Not many people had this, but he. So I had the three choices: bar of chocolate, pound note or sovereign. Well, the sovereign just looked like a coin to me, so I took the pound note. And well, none of his friends did laugh at that because nobody knew what a sovereign was. So, but then my granddad tried to explain to everybody that the sovereign made of gold was worth more than the paper money. My granddad worked for HMRC, the tax man in the UK, so he understood about investments. But I don't think even after his explanation, I don't think any of his friends got it. At the age of 7 years old, I certainly did not get it. But he was obviously trying to explain what's called Gresham's law, where the bad money drives out the good, or is it the other way around? But basically, people conserve the good money, the money made of gold, and get rid of the paper stuff, which is worthless. That was what he was trying to explain. But many, many years later, and it was probably around the same time as I looked at his stock market portfolio, he gave me this gold sovereign, and he said to me, Clive, I want you to keep this forever and don't tell anybody. Well, I broke the second rule, but I've still got it today. But by the time I was 18, I actually took it down to Sharps Pixley in London. I was working in a bank in London, and Sharps Pixley was in the same building. So Sharps Pixley was a jeweler, or rather a gold, silver seller. And I took it in and asked them what it was worth. And I can't remember what they told me, but it might have been they were going to say they'd give me £10 for it, or they'd sell me another one for £25. It was a huge difference. I didn't like either of the prices. But it got me interested in the fact that this £1 coin was worth perhaps 10 times as much. And then I made the silly mistake at the age of 18 of walking around the banks, seeing if I could change a pound note into a sovereign. Of course, I had no luck with that. But the
They didn't
naivety,
change it.
well, of course not. No, of course, the gold was not in circulation. But, it was a £1 coin. So I thought, well, they ought to change it. But obviously, I quickly learned that there's no way you could change a pound note into a gold coin, even though that was the official exchange rate back then.
Yeah, so no gold standard anymore.
No, we were. I mean, this was after America had got off the gold standard anyway. It was after 1971. It'd been mid 70s, late 70s.
What is a high net worth individual like?
Um, in Switzerland, we tend to regard it as people who've got more than £1 million of investable assets. And I think that £1 million, $1 million figure has been moving upwards. So probably you'll find it difficult to open a Swiss bank account as a foreigner unless you've got more than $3 billion these days. And of course, there are banks who want 10 million even.
Right.
But then we have a concept called very high net worth, VHNWI, very high net worth individual. Those are the people who've got hundreds of millions, or if not billions. Unfortunately, I didn't come across a lot of those in my career.
The story you just told me, it leads somehow to financial education finally, and that is my next point. I want to talk about financial education, and I see financial education as being a big gap in education in general. And I want to ask you, since you have a long career, why is that? Why aren't the masses financially educated? Is this by design, or how do you see this?
I think it's a great shame that the schools around the world do not teach young people about how to go into the big wide world and manage their finances, how to do a household budget, how to pay your rent, how to get negotiate a discount on a product you buy, and of course, more importantly, what are your savings options and what are the advantages and disadvantages of each? There's a whole world of things out there related to finance, and of course, they don't teach other things that we need to know, like how to get a job, how what's marriage, what's a divorce, what are children. Obviously, we know that, but you know what I mean. They're not really explaining to younger people about how they can go into the big wide world and financially survive. It's pretty much we'll teach you, English, maths, history, geography, science, and then there you go and get a job. Well, of course, the jobs aren't there, and people are thrown into this big wild world without the one skill set they need, which is how to manage their money.
It also doesn't teach, for example, how to manage the risk. So everything we do has embedded a risk inside that. So it might go well, it might not go. So it doesn't have to be money. It could be any project. And considering associated risks and what to do to minimize them is also not really taught. And how do you think about this?
Well, all my career was around risk management, which in investments really, and we're talking about asset allocation. The dream of every asset allocator is to find the perfect portfolio, which is where your different asset classes are sufficiently uncorrelated that you have an upwards only slope, one way only, with very, very little volatility, very, very little downside. And asset allocators have been trying to find that perfect portfolio ever since the beginning of time, but certainly throughout most of my latter career. And it doesn't exist because there's no such thing as something which goes up in a straight line unless you put cash in a bank on deposit and you earn interest. But of course, we learned in the global financial crisis that many interest rates went negative. Maybe not in America, but if you were in Europe and you had euros, for example, almost certainly above a certain limit, your bank would write to you and say, "We're going to charge you a negative rate of 0.5% or 0.25% on your euro deposits." Then they'd obviously, as a sort of sideline, say, "Oh, and by the way, we've got some products which you might be interested in." Of course, these are products which involve risk because there's no such thing as no risk. So even cash on its own is not an upwards only strategy. It usually seems so. But the real problem with that type of low risk strategy, cash only, is that you're earning interest, which is way below the amount of money and debt creation. And I'm using a word which is not usually used by people because people talk about the money supply being the real inflation rate. But I think the real inflation rate is the combination of government debt and the money supply, because in the modern world, government debt is as good as cash. You can turn your T-bills into cash in microseconds if you have online, and so it's as good as cash. So as the government runs deficits, it needs to borrow more and more money. And in borrowing, the government gets poorer because the government then spends that money. But because the government's getting poorer and spending the money, someone gets that money they're spending, or everyone gets it. So collectively, the world gets richer. And of course, there are people in the world who are better at keeping that money than others. So the money flows to the wealthiest. But at the end of the day, people are getting richer as the government gets poorer. And we know that ever since the beginning of time, and this is not just in this century, it's the centuries gone by as well, and right back to the Roman times, no matter who was in power, they always had a habit of overspending, whether it be on wars or in more modern times on social security, on funding people's unemployment and things like that. So governments have always been getting poor. And ultimately, the end result of government getting into too deep debt is that they default and in some way, shape, or form. Now, in the modern world, they usually don't stop paying. They usually just run the currency down into the ground until it's completely worthless and then start a new one. So it's not actually a default, it's hyperinflation is the end game. Um, so I think that's kind of the world we're in now, where people are getting richer because, at least richer in nominal terms, because the government is getting poorer. And so it's the combination of the money supply and the government debt, which is indicating the true inflation rate. That drives the inflation rate to maybe inflation in those two things to maybe 7 or 8%. When you're earning, it depends on your country, but certainly less than 5% everywhere, and in many countries less than 3%. And then you're probably paying tax on it. So your net return after inflation is almost nothing. So what is this inflation rate I'm talking about? Because people are looking at the retail price index or the consumer price index and say, well, the prices are only rising by 2 point something percent or 3 point something percent. What's he talking about? The inflation being 8%. Well, what I'm talking about is the consumer price index, the retail price index, measures the prices of things that are mostly made by robots, iPhones, frozen pizzas, cars, it doesn't really matter. But when you're saving for something important in the future, like to buy a house. Now, there's only a limited number of houses out there, so that's why your house today costs 10 times or 100 times what it cost 50 years ago. It's why going on a cruise, where there's only a limited number of places on the cruise ship, costs a hell of a lot more than it did 20 years ago. It's why when you go into a retirement home in your old age, paying for the cost of that retirement home is going to be a lot more expensive than it was 20 years ago. So the reality is that the prices of things which are in limited supply are in fact rising by at least as much as this 7 or 8% inflation. It's only the prices of the things which are made by robots where the robotic component of it is becoming more and more, the human labor component is becoming less and less, where the prices are kept to some extent in check.
Right. So when we talk about inflation, there is the CPI, as you mentioned, and there is the everyday experience. So everybody can go on shopping and look to the bill and compare it, but it doesn't match. So I just for exercise, I was looking to the methodology the governments calculate inflation, and there is something there which I personally didn't feel comfortable, and that was there is a very big number of products into the basket. And I've run a poll about this, and there was a consensus saying that around 30 products can give you pretty much an idea of proper inflation. But they put 300 there. And on top they have this weighted average essentially. So to me, I'm not saying that you manipulate, but if you wanted to do something like this, so you have this number of products and this weights allow basically for you to come with any number you want without not being finger pointed here and there. uh,
Well, the consumer price index, in reality, is a what the housewife can afford index. So it can't increase by more than what the housewife has, by what she has available to spend. Because the way it works is it weights what she spends her money on. And I use she because obviously it's to a large extent what you're spending on things like food. Obviously, there's rent and other things in there, but it weights the spending by item according to how much you spend on it. So if I give you a little illustration of how they manipulate the index, let's say the housewife has only got two items in her shopping basket. It's potatoes and bread. And the potatoes cost £1, $1, and the bread costs $1. So the index should be at two. She buys one of each, one potato, one bread, both cost a dollar. That's index level two. But next week, the price of potatoes doubles to £2 or $2. So now the index should be at 50% increase. But the housewife hasn't got any more money, so she can't afford to buy potatoes anymore. So instead of buying one potato and one bread, she buys two bread, both still at £1, and she buys zero potatoes at £2. So the weighting of potatoes goes to zero, and the weighting of bread goes from 50% to 100%. So the index stays exactly at two. It hasn't gone up at all, even though the general level of prices has increased. So that's the first manipulation method. And the second manipulation method is to call improvements price reductions. So if you buy a better car this year than you could have bought 10 years ago, the price might be the same as 10 years ago, but that's called a price reduction because the car you're buying today has got more gadgets and items in it. It's got a radio, it's got a screen, it's got LED lights and all sorts of improvements. So technically, that counts as a price reduction rather than staying the same price. So those are the two ways in which the index is manipulated. But the key point about this is the index, the CPI, can't increase by more than the money that people have got to spend. So it's not really reflecting the true rate of inflation of the underlying. It's reflecting how much money the man's got in his pocket.
and on top, we've got as well shrinkflation. So you have the feeling that you are buying the same uh, packet of something, but the content inside, the packet remains the same, but the content inside, has diminished.
On that, I saw a very interesting example with the US CPI figures it was last year or the year before, I think. I noticed that in 1 month, they dropped the health insurance component, that's the premiums that people are paying for health insurance in the United States. They dropped it from a certain percentage to, I'm going to say, let's say half as much as a weighting. And that happened to be one of the things where the prices had risen a lot. So what are we to conclude? It were they manipulating the figure so that this big price rise didn't appear in the end CPI number, or was the reality that people were indeed spending less on health insurance because they could no longer afford the much higher premiums? And I think that was the truth. The premiums had gone up. Lots of people said, screw this, I'm not having it anymore. So the weighting in the index went down, but prices had gone up.
Related to inflation, what is money, Clive?
Well, if you look at the textbook definition, I think there's about 7 characteristics, but one of them is called store of value. But what we use today, which is banknotes and bank balances, they are definitely not stores of value. So in that respect, the fiat money that we have today doesn't qualify as money, even though it's called money. Um, it has many of the other characteristics of money in the old style in terms of being fungible and a medium of exchange and so forth. But it certainly has lost its store of value because uh, the amount of money on the planet is going up and up and up, and there is no end to it, and there can be no end to it until it's replaced in individual countries or perhaps altogether at the same time by something new, which will come with the promise that we'll never let this happen again. Sorry about your old money, which we're really sad it became worthless, but it wasn't our fault. It was all the fault of the previous government or the fault of these wicked companies putting up the prices, or be somebody else's fault, of course. But here we are. We've got a brand new money, and it'll never happen again. That will come in due course, and it's you can't give a date, but I think we're in the 5 minutes to midnight period now.
So if there is no store of value, uh, essentially I can't plan for the future. Is that correct?
Well, this is where financial education comes in because there's a lot of options out there, depending on your age, where you can protect your wealth against the devaluation of the currency. A very simple example, which most people have figured out, is to buy your own home if you can. And if you can buy it with borrowed money, even better. So the sooner you buy it, the better. In other words, get a mortgage, buy now. Don't wait till you're 60 years old and got enough money to buy the house, because by the time you get to 60 years old, the house price will be a lot higher than it is today. So that's obviously a way. But of course, it's not just if you have wealth or savings beyond what you need to put into the deposit on your house, then there are many options which are worth considering. And there's no one option which is definitely going to solve the problem, but collectively they will, because all that money slushing around the system has to go into something. So, what are the other options? Well, they include things like gold, like equities, like property, like Bitcoin, works of art, heirlooms, silver, basically anything which you can find a way to hold and preserve for the long term, and it won't deteriorate over time. Now, not everything's going to work. I mean, when I was a child, it seemed like collecting stamps was a good idea to preserve wealth, because you could go to the stamp dealer and buy an expensive stamp, and you're pretty sure you'd be able to sell it back, maybe not at the same price, but certainly for value a few years from then. But of course, who collects stamps these days? Unless you have an extremely rare and unusual one, it's lost all of its value. The stamp collecting shops like Stanley Gibbons, they're chock-a-block full of old albums that nobody wants anymore, and the prices, are dirt cheap for those who want to go in and buy them. They're not worth even a fraction of what they were worth when I was a child, and we're talking 50 years ago now, 60 years ago.
So there is no one money then. So there are many money, I would
Many
say.
ways of
So
saving. Yeah, many
real,
ways of saving.
right. So real estate could be under certain circumstances considered as money. Gold could be money. Maybe your stock portfolio could be money. Then is this a good way to define?
Well, I think I wouldn't use the word money because money is the thing which is on a date in today's meaning. It's what's used for a day-to-day exchanges. Though of course the traditionalists would say the only true money is gold. And then, of course, you've got the bimetallic people who say it's gold and silver. But, I think a lot depends on where you live. If you're living in some countries, perhaps in Africa or somewhere, not all of Africa, but some African countries, money would be cows or goats. How many of those have you got? Um, so everything depends on where you are and what's available to you. But I would say those kind of things I've described are not so much money, but they are stores of value which can be turned into equivalent buying power when you turn it into the currency of the day, whatever's legal tender, whether it be tomorrow or 5 or 10 or 20 or 30 years from now, or when you retire at 65 or beyond. And you really, when you're elderly, you've saved all your life, you want to have a comfortable retirement. So you're saving for those luxuries that you deprived yourself of when you were younger, such as a better home, better health care, or better, maybe a nurse to look after you if you're very elderly. You want some things to reward you for your hard work and your saving effort during your life. And you can't do that, or you won't be able to do that very easily if you're saving your money in cash and bonds, because you're just going to be going backwards year after year after year. And you'll get to your old age and say, gosh, I've saved 1 million, but now houses cost 10 million. It just won't work.
So you are running after a moving target, potentially by risking to never catch it.
That's right. It's running away from you faster than you. It depends how much you can save, but many people will find that maybe the early stages of saving, they can save at a faster rate. In other words, their wealth is increasing, but through saving new money, it's increasing faster than the money supply increase. Because if you imagine the first year you save, let's say 1,000, and the second year you save 1,000, now you've got 2,000. Well, your wealth has just increased by 100%, but the rate of inflation isn't anything like that. But by the time you reach, let's say, 50, now you've got 100,000 in the bank as an illustration, and you save another 1,000. Well, that's only adding 1% to your assets when the real rate of inflation, because government debt is going up and money supply is going up, is really 7 or 8%. So you've gone backwards by 6,000.
I want to change topic now and talk about wealth with you and how people can become wealthy. Is there one way? There are many ways. How
Well,
do
many ways. Something I'm not privileged with is to have rich parents. That obviously is if you could choose your parents, go and choose a billionaire if you can. But so you can get lucky, and for sure there's lots of people get lucky. But the reality is those who get lucky have a trouble hanging on to it. We all hear about these stories of people who won the lottery, and 10 years later it's all gone. One of the ways to I'm not talking about investments yet, but just generally, one of the ways to get wealthy, and I'm talking here about what many of my clients did over their careers, is to start a business and run it with some kind of leverage. Now, what's leverage? It's when you employ the work and efforts of other people. You employ people. So, give you a very, very simple example to understand the concept, but this can be applied to any business. You could be the lawnmower man, you own a lawnmower, you cut people's grass, and you make a living. Or you could own 10 lawnmowers and you could pay 10 people to cut grass, and you do the billing, and each person who cuts the grass gets 50% of the fee, and you collect the other 50%. So now you've got the equivalent of 5 salaries coming into you. That's leverage because you're leveraging the human labor. But the other sort of leverage which can be used would be other people's money. So if you could borrow money from a bank to start a business, or if you could borrow money or have people subscribe to shares in your business, And obviously, many of the biggest companies on Wall Street or many of the companies on Wall Street got to be on Wall Street on the stock market because there were investors willing to subscribe for shares. So they collected a lot of money. And with that lot of money, they could employ lawyers and accountants and engineers and specialists and salesmen and marketing professionals and pay for outside agencies to do the advertising, all kinds of things. And they could become very large companies thanks to other people's money. So, that's a route to get wealthy if you can find a way to either employ other people or use other people's money in some way. But there's a harder way and a slower way, which I will apply to myself. And I can sum it up in very simple words. It's work hard, spend less than you earn, and invest the rest wisely. Now, if I go back to when I was young, I mean, I started cleaning cars at about the age of 12 or 13 years old. At the weekends, I'd go out and wash cars. By the time I got to 18, I had saved a vast sum of money. It was £500, British pounds in those days. That's about, for your American listeners, about $600 or something like that. That was from the 6 years of work. But by the time I got to 16 years old, I was still at school and I managed to get myself a nighttime job after school as what they call a bingo caller. That's somebody who stands on the stage and reads out the numbers. And I got this job in a place called Leytonstone. Well, actually, it was three places: Leytonstone, and Walthamstow, which are kind of the east end of London. They're quite upmarket places these days, but back then they were a pretty rough area. And I was an Essex boy. They couldn't employ anybody locally because they couldn't trust the locals. So they had a nice posh Essex boy with a good accent come and read the numbers because they felt that yeah, they didn't want anybody local doing it because there'd be too much connivance between the punters and the bingo caller. Perhaps the bingo caller might be dishonest, reading out the wrong numbers or something. So I managed to start saving some money like that. And then I got a job, my first job in bank at the age of 18. And one of the rules when you worked for a bank is you were absolutely prohibited from having any other job. I decided to keep my bingo caller job and not tell them. And there was no way they could have found out. I mean, there was no internet or anything. There's no way for them to research it. So for several years after I started work, I had two salaries coming in, and that was handy, and it allowed me to save quite fast. And I was putting money into a building society. The way it worked back then in the 1970s is you couldn't buy a flat unless you had been saving for 3 years, and then they would lend you an amount to the amount equivalent to what it would cost based on the monthly savings you'd be making over 3 years. You had to commit basically to make these savings, which I'd done so. So after 3 years of working, I was qualified for a mortgage based on the contributions I was making to my monthly savings plan. And I bought my first apartment. It was a very small apartment on a long way from London, but about an hour on the underground into central London. That cost me £13,000, but I didn't have to pay the £13,000 because I borrowed some money from my parents, a couple of £1,000 from my parents, and the rest was what the building society would lend me. But it still wasn't quite enough in terms of servicing it because I was a pretty salaries weren't high back then. So to make ends meet, I moved in a lodger. Now, this was a one-bedroom flat. So it was a female lodger, and I luckily ended up marrying her. But so effectively, we had two people paying the rent, or not paying the rent, two people contributing, so I could pay the mortgage. And I had two jobs, and there was no television, no telephone, and we weren't eating any meat. That was how we saved money. But the good news was, excess money, I could then put it to work in the stock market. Now, obviously, my first investment turned out very, very badly. I lost 100% of it, but that was my first punch on the nose. And I looked at myself and said, what did I do wrong? And I realized what I'd done wrong, and I tried not to make that mistake again. And just to keep it simple, what did I do wrong? I listened to a tip from somebody else rather than doing my own research.
When you decide to go to the stock market, for example, in my case was let's read this book, let's read that other book, fundamental analysis, technical analysis, and I thought I have everything under control, but it was almost a disaster because I realized that book gave me only 10%, kind of. 90% was only emotions. And that was something I couldn't train by reading books. I just had to have skin in the game, and from time to time, like becoming maybe more conscious of things, maybe limiting positions, maybe trying to find ways where I could say, if this doesn't go well, then I still can be in the game somehow. Uh,
I read all the famous investment books when I was young. My bookshelf, you can probably see behind me, I've got a lot of books, and that's just a fraction of the ones I've read over the years. And you're absolutely right. You could get a pretty good idea how to do security analysis and choose stocks from those books, but it doesn't teach you anything about the emotional aspect. So the problem, and I managed to overcome this problem after 18 years of investing. You might find that a long time, but that's really realistically look how long it took me to overcome the emotional side of getting it wrong. The problem with investing is when you've done your research, you've become very excited about the company or companies you've found, and you want to put all your money into these companies, and then it always seems to happen. The day after you bought it, the price goes down, and then 6 months later, you've lost 10 or 20 or 30%. And you say, how is that? I chose this wonderful company, and somehow the share price has gone down. Has everybody else got it wrong? Or is this an even better bargain? And should I borrow some money and put more money into the same thing? Well, of course, the temptation when you're quite young is to think, well, if I got it right the first time, it must be an even better bargain the second time. And so you try and find some more cash and put it into the one which has fallen the most. And this also works in a certain sense in the opposite direction. So you put 10% of your money into a stock and it rises 10 or 20%, and you're feeling absolutely fantastic about yourself because you made a profit of 10 or 20% in 6 months and you've only got 2% or something on a bank deposit. So you rush to sell. The next day, the share price is 3% higher, and a month later, it's 5% higher, and 2 months later, it's 10% higher. And you're thinking, what was I doing? Why did I sell when I could have got so much more? And maybe you're looking 5 years later, it's doubled or tripled or quadrupled. Um, so this was a very, very difficult thing to handle in the early years because I'm very driven by emotions of getting excited with profits and throwing good money after bad when things went down. But I finally solved the problem. I'm going to share this with all your listeners and viewers, and viewers. It's a very important lesson that everyone can learn from me and save yourself 18 years of pain. And it's this: when you invest or when you want to invest in something, never invest the amount you would like to. Divide that amount by three and invest 1/3 into that investment. Now, what that means is when the price goes up by 10, 20, 30%, you're going to look at it and say, you know what? I should have invested so much more. That 20, 30% isn't worth the biscuit. It's not, it's not enough. I don't feel rich enough to grab that profit. So you let it ride, and then it could go to your 50% up, 90% up, 100% up, and then beyond. Because the profit on that 1/3 position isn't big enough to get you excited. And likewise, if you've only invested 1/3 in a particular stock and it then goes down, you might have lost 10 or 20%, but it's 10 or 20% of
One
only
third.
1/3 of what you would have risked. So you now have two choices. You can either say, well, it's 20, 30% down. I don't care. I'll just leave it. Or you can say, I'll revisit the company, restudy it, and see if it's worth buying the next 1/3 at today's price. And you have an option which you didn't have if you'd put all your money into that stock on day one. So now you look at the stock and you judge it, and then your option is either buy more. Of course, you also have the option to sell it, but if you sell it, you're only losing money on 1/3 of what you invested. So the loss is not important anymore. It's insignificant. You don't care. And we mustn't forget that when you buy a stock, The maximum you can lose is 100%. The maximum you can make is unlimited. So even if you put somebody into a stock and it's only a one-third position, it goes to zero. Well, thank God, you've only lost a third of what you would have risked if you'd done what you wanted. Whereas if it doubles or triples or quadruples, well, you've made far more than the maximum you could have possibly lost. So that's my trick. When you buy, only invest a third of what you would like or what you planned, and keep the rest in reserve, perhaps to buy something else, or perhaps to buy the same thing later on if the price goes down, but only if after it's gone down, it's still a buy of a lifetime.
This would allow to limit risk on one asset, on one stock. But money managers talk about diversification as well in terms of reducing risk. So there is one dimension is don't enter immediately with everything you have into the position. Another dimension is, well, take whatever you have to invest and maybe diversify it. So then we have already 2 degrees of optimization. And then one could add another dimension, which is, well, there are stocks, meaning businesses, but there are commodities. The class of assets is not just one. So then we already are at 3 dimensions. So we try to solve an optimization problems across more dimensions, and we want to maximize returns, but we want also to minimize risk. So how because potentially there could be too much for someone to take into account. What is a good way, like, to not become mad and get it kind of right?
Again, a lot comes down to understanding your own risk tolerance, because investing wisely probably means not having too much in cash. I mean, I'm talking wisely from a optimization point of view to have the maximum gain for your money with a minimum impact on your wealth, minimum impact due to inflation. But if you're a very nervous person and you're going to lose sleep at night if things go the wrong way, you probably have to stay in very safe investments like cash, and accept that you're going to be in the later years, you're going to be running backwards year after year after year. I mean, there are people now who are in their 40s and 50s who are contributing to their pension plan, which they'll get when they're 65. But the amount they're contributing, plus the growth in the size of the pension fund, is not enough to compensate for the rise in the cost of the things you want to spend your money on when you retire. So they might think they're going forwards, but they actually go backwards. So in many cases, the best thing they could do is retire early, pull out the money, and take the whole lot and invest it in a much wiser way than your pension fund was investing it. It's something that I personally wish I would have done perhaps in my 50s, because if I had done that in my 50s and dumped the whole lot, I'm not saying I would have dumped the whole lot, but let's say I dumped the whole lot into the stock market, I'd have done a lot better than continuing to work and contributing to the pension fund, because the increase in the pension fund, I don't know what it was, but let's say with my contributions and the growth over the last 10 years, perhaps it increased by, I don't know, 30%, but the stock market probably went up by 100%. So I was actually in the later years going backwards. When we come to investing for the private individual, to the extent you've got money available in your name and you can invest it wisely and not have someone else to tell you what to do with it, you need to have all the asset classes that you think will do well. And these are generally tangible asset classes. They obviously include real estate, but they include equities, they include gold, they include silver, and each has got its own features. They'll move at different speeds at different times. There'll be times when gold's outperforming equities. There'll be times when equities are outperforming gold. There'll be times when commodities are doing very well. And there'll be times when property is doing very well. And of course, we've got this thing on the side that a lot of people love, and I'm not against it. I think it's a great idea to have a little bit. It's Bitcoin. You see, I've got the Bitcoin Standard book on my shelf there. So and of course, if you want to extend beyond that, when you do employ an asset manager, he's going to find many things beyond those major asset classes. They call them hedge funds, they call them alternative investments, they call them high yield funds, they call them long short funds. They're insurance bonds and factoring and private lending funds. So there's all kinds of things out there which offer the inverted commas here prospect of better returns or modified risk. A good area which is very popular are things which are called reverse convertibles, barrier reverse convertibles, low strike reverse convertibles, and then there's other instruments which leverage the return. All of these things modify the risk and the return, offering you as the investor the prospect of at least keeping up with inflation, whilst at the same time having a lower risk than if you put all your money into just one thing. I mean, think of it in extremis if you put all your money into a Bitcoin. I'm not saying that wouldn't have been the greatest idea on the planet. It clearly would have been if you'd done it many years ago, but it's a very volatile asset. So you can imagine how people feel when it goes from 100,000 down to 70,000. They think, oh my God, I should have sold at 100. And then it goes from 70 to 150, and they think, oh, I should have bought some more at 70. And of course, there are people out there who have done that. And there have been moments when they've been feeling very despondent because it hasn't done what they thought it was going to do. And there's been moments when they feel very excited because it's gone to the moon. But if you can't handle that sort of ups and downs, you need to be invested in a lot of different things. And I every year or so, I publish on LinkedIn a recommended asset allocation table for multi-millionaires who are willing to take maximum sort of risk. So just to give you a picture, I haven't got it all in my head, but it's typically 60% in equities, 12% exposed to precious metals in various forms, perhaps 15% exposed to real estate, mainly through real estate investment trusts. I exclude the personal home and physical assets, physical properties. Then there'll be small allocations to specialized bond funds and customized investments and allocation to private equity. It's just a framework. And of course, there's also an allocation to cash because everybody needs to keep some level of cash. I would say somewhere between 3 and 10%, depending on your wealth. That's for a person who's able to take the maximum risk. You need to keep some level of cash because you don't know what's around the corner tomorrow, what opportunities are going to arise. So you need that flexibility to move around into an investment, and then you can spend your 3% cash or 5% cash, and then think about what you're going to sell to get back to where you were. So you've got some money for the next investment when it comes along.
So you mentioned everybody should know what is his appetite on risk. Risk by itself means probably nothing. It's about a risk within a time. So how much risk can you accept within a month, 6 months, 1 year, 10 years, etc.? Because that really changes everything, completely the mindset.
Can I butt in here? There's
Sure.
two types of risk, and I think risk is often used in the wrong way, and I probably just did. We have the risk of total loss or default, or counterparty risk, if you like, and we have the risk that the price changes up and down. So to illustrate that, if you have a bar of gold, the price will not reach nothing. It will go up and down. If you own a property, the price should not reach nothing. I mean, I'm assuming there's no property taxes which make it unattractive. But logically, when you have a tangible asset, the price can't fluctuate down to zero, or should not. I mean, I know a few years ago we had oil on the futures market trading at negative $30. That wasn't actually a physical barrel of oil. But realistically speaking, if you own a bar of chocolate, it's not going to go to a negative value. If you own an ounce of gold, it's not going to go to a negative value. So there's no counterparty risk. So there's no risk of total loss. On the other hand, if you own a stock or a bank deposit or a bond, there's the potential for 100% loss if your counterparty defaults or fails. If you own a portfolio of those, there will be some failures in it potentially, but most of them are going to survive because the world survives. So, if you imagine, as an example, you owned, and nobody's going to do this, but you owned every company which supplies food on the planet, some will surely go bust. But mankind is always going to be needing food. So when one goes bust, the business then passes to the survivor who does so much better. So collectively, with a portfolio of stocks diversified, you're staying in the game, even though collectively the prices will fluctuate. And inside that portfolio, there will be some big losers, but there will also be some big winners. And you have to be in the game and have that diversification, because if you're in too few stocks, you might be the unlucky guy who chose the bad ones.
I remember when we had our first child, so we went to the bank talking with an advisor, and it proposed us something which was in the direction of investing in the stock market somehow, but really being very low in risk. And that day, we left the bank feeling that we have done a good thing and then at low risk. After a bit, I realized that actually I was in the risky investment because and this is I'm telling this to highlight a different corner of looking at risk, because I could have invested simply in the S&P 500 and do nothing, and maybe have at least a 10% return. So at that moment, to me, I just realized that I made a risky investment in this sense. Does this make sense to you?
Yeah, I mean, the risk when you make any investment is that it doesn't perform as well as what your friend could have chosen or what you could have chosen. One of the things one encounters as a wealth manager is there will always be people who, well, I say it's actually extremely rare, but it does happen rarely, that someone will ring up and say, "My friend at blah 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 investment firm bought this. Why didn't you tell me about this?" And be a Nvidia or some stock which has gone to the moon. It is always a risk that you'll find something which could have done better. And as you said, in your situation, you probably bought what's called a customized investment, which offered you a modified risk and return. In other words, you'd only lose money if complete disaster struck, or maybe it was even capital guaranteed. But the quid pro quo was you were locking up your money for a period of time and you had no choice over it. And the return, perhaps it was maximized at 5% or something like that. Maybe they offer you no downside risk, but with a maximum upside of 5. So the S&P goes up 5, your quid's in, you've made the same amount. Now the S&P's up 10, but you're capped at 5. These are called, that's what I called customized investments. And they modify the risk and return, giving you some of the upside, but not all of it. And then you realize you'd be better in the riskier asset, the S&P 500. But of course, if the S&P 500 had gone the other way, it had gone down 10%, you were probably in a product which had a capital guarantee that you couldn't lose more than 0 or more than X%, and you wouldn't have lost as much as the S&P 500. I'm not against these products, but I'm not in love with them either. I think they have their moments and they're the right thing for the right people. But you don't want to have, if you're trying to maximize your long-term gains, there isn't a great deal of point in trying to limit your downside, because limiting the downside means basically insurance. So behind the scenes, although you're not seeing this, someone somewhere is spending money on your behalf to buy what's called a put option to limit the downside risk. And that put option has effectively a lot of fee in it. It's called time value. And because someone else is basically taking the other side of the risk, so they want to be paid for it. So you're basically paying insurance, just like you pay insurance on your house. Year after year, you pay insurance on your house. It's costing you, and you're getting nothing back for it unless disaster strikes. Well, the same thing happens when you buy a customized investment. Even though you don't see it, unknown to you, you are paying for insurance to reduce your potential loss or protect you in some way. And that costs money compared with having the outright asset. So that's the choice you've got. You buy the underlying asset, the S&P 500 in your case, or you buy the product which has got the insurance. And I don't, I think there are moments when it's probably a good idea to have the insurance, but I wouldn't put 100% of my assets into that type of asset. A little bit, why not?
Well, in my case, the plan was so it was meant to be like a 10, 20 years investment plan, so long term. And when I would see what the S&P, I'm mentioning S&P just to say the market, let's say, uh, what have done over hundreds years, and it has a return kind of an average of 10%, let's say. So suddenly, even with risk volatility on the S&P, which might be 1 year, 2 years, in a horizon of 20 years, and looking to statistics, I, I saw no risk basically on that because I was not there for maybe 2 years or 3 years. So
If I was to show you or anybody a chart of any index, the S&P 500, the FTSE 100, the Euro Stocks Index, let's say, going back to the early 80s or to the 1970s up to today's date. And then I would say to you, find for me where the last crash of 30% happened. You wouldn't be able to find it because it's invisible on the chart. The chart is massively, it's flat to start with and it goes straight up, but somewhere in that flat part, in fact it's October 1987, stocks crashed by 22% in the USA in a day, 30% over a few days, in most countries 30% on a single day. But you can't, it's not even a blip on the chart unless you blow it up, and then you can start to see it. Of course it looked very scary for people who were involved in that blip which lasted a few days back in October 1987, but now it's almost like it never happened because are rising more in a day in money terms, nominal terms, than the amount the index fell when it fell 30%. So you're getting a 1% rise in the index today is the same in number of points as that 30% fall was in 1987.
uh, blockchain. Now, this is something relatively new. It started with Bitcoin, and uh, in the meantime, we are talking about 50,000 tokens there. Maybe 90% is just gambling. But if I wanted to add uh, crypto, and I know that there are many cryptos, but let's use the term as general as possible. And I wanted to be exposed at least to these new technologies coming, and how do I find the value?
Um, I'll start with Bitcoin. I could clearly see where the value and the utility of Bitcoin lies. Um, and it's this. Bitcoin's been around for 17 years. It's been up and down, up and down. And I have confidence that it will still be there tomorrow, next week, next year. It's not going to go away. I don't know if the price will be higher or lower. I'm not speculating on that. But here's the utility. I know it's going to be around. And although I personally don't feel I suffer any financial personal risk because of my personal lifestyle, the world is chock-a-block full of people who fear that everything they own will be taken away from them. They might be politicians in a of a rogue government, or they might be friends of a politician in a rogue government where sanctions might come down like be clamped down, and suddenly you can't. And this happened to one of my friends here in Switzerland. He happened to be a Russian. Not his fault that he's Russian, and he doesn't actually like Putin at all. But when Russia invaded Ukraine, banks around the world literally froze Russian assets. It got lifted over time because they then tried to sort the wheat from the chaff. But you can imagine you might be a good friend of an oligarch somewhere, and you are targeted by sanctions, and suddenly you find all your assets are frozen. Well, if you've got 12 words in your head, which comprise your Bitcoin account, and you can remember what those 12 words are, you can then move to a country which doesn't have sanctions. You can't move your money because it's stuck, but you can move yourself, and with it, as you cross the border, even if the border guards search you and try to take your gold, they can't take your Bitcoin off you. You can take it with you. So let's extend that to a businessman who perhaps has built up a highly leveraged and risky empire, and there is a danger that that empire might fail and he'll be taken down with it for his personal assets. He'll be sued and he'll lose everything he's got. But he's got his Bitcoin and he can perhaps revitalize that later on and start again. And then, of course, you've got the battered housewife. You know, she's got a very controlling husband who doesn't let her have her own bank account, monitors everything she spends money on. Now, she could secretly build up on her telephone a Bitcoin balance. I mean, here in Switzerland, I don't know how it is in other countries, but you can go to the post office and buy a scratch-off card with a Bitcoin code on it, and then you can transfer that to your phone. You can go to the railway stations. Every ticket machine in Switzerland will sell you Bitcoin as it's called other tickets, but you just put in other tickets and then put your $500 or $600 into the machine and hold your phone under the machine. The Bitcoin's on your phone. So she could secretly build up that store of value, which she couldn't in cash or any other form because her husband's so controlling. So when the day comes to do a runner and start again, she's got something with which to start again. And then, of course, you've got people in countries which are not very like ours, not as safe, where perhaps there's rival tribes in the next village who might invade your territory and steal your goats and your cows and your pigs and your chickens and your children and your wives and your hut, and you're going to have to run in a hurry. And now, all very well having a lot of gold on you, they're going to take it off you, but they can't take your Bitcoin. So that's the value of Bitcoin. It's the fact that it's going to be there tomorrow. And I don't, if I was one of these people who feel that my wealth might be taken away from me for unjust reasons, maybe I live in a country where you have a very bad political system, a lot of corruption, and I might have enemies. I'm not a politician, but I'm maybe a businessman. I've robbed some people up the wrong way. I've got enemies. If they want to, they might be able to bring me down and cause me to lose everything I've got, but they won't be able to take my Bitcoin. So the utility is, I don't care what the price is, but I have a belief that when I arrive somewhere else, if I have to flee, that Bitcoin is still going to be worth something. I don't care whether it's more or less. I can start again. So that's the value of Bitcoin. Now we go to the other altcoins. Each of them in its own way claims to have a use case, and 90% of them probably don't or never will. Obviously, Ethereum has the use case of being really good for smart contracts, and I'm sure there's some others out there which are very good for smart contracts. People talk to me a lot about Ripple or XRP. I've played with it at some point, but to be honest with you, I don't really. I think Ripple Labs are doing just great. I mean, they've got all these XRP, and every time they need to fund themselves when they run out of money, they can sell some more XRP and keep the business going. So, Ripple Labs, great for them, but I don't actually see that. I mean, it may happen, but I don't actually see that the world is suddenly going to start be using XRP instead of money. It might happen, but I don't see that as happening. I'm not even sure they're going to use Bitcoin as money. I see Bitcoin more as continuing to be a store of value from people who trust it will still be there tomorrow. And the fact is, it's got a network effect. You have to believe that just like an ounce of gold or a dollar bill, that there's enough people out there in the world who are willing to take it off you and give you something in exchange for it. And I think that's, Bitcoin has been around long enough, and the number of people who are willing to give you something in exchange, something of value in exchange for it, is not getting smaller. So that I think Bitcoin's around, but the rest of the altcoins, I think, require a lot more study to see if really there's enough of a use case to make them investable, or if they are investable, are they worth what the price is today? That's not a study I've done. But there are specialist funds. You could go into Bitcoin, not sorry, Bitcoin, crypto funds. I'm invested in one as it happens, but there's plenty of crypto funds which specialize in having or claim to have this special expertise of being able to pick the winners from the losers. So for those who can't do it themselves or aren't prepared to spend the time, and if you have enough money to qualify, because usually to be a qualified investor in some way, shape, or form, yeah, there are funds out there which will do it for you.
Okay. So Bitcoin is in all this universe by its own, for what you mentioned. And
Yeah.
the other area where you can find value is qualifying for funds who are built from specialized people who know this world. Um, when I try to find value, for example, speaking about Ethereum, I understand Ethereum as an infrastructure, um, but I find difficult to find the value in the token itself. But the value is on the application side of it. So whatever application can be built on top of Ethereum because of the smart contract it supports, that the application itself might have huge value, might be the next Amazon, whatever. But the token itself, probably it ends up to be just a utility token, and the token itself is not where the value is. What you're taking to this.
Well, something which has utility is needed, and therefore the price is determined by the supply and demand. Now, I haven't studied, as far as Ethereum is concerned, what the supply or the demand is like, but I do know for a fact that in years gone by, when you did smart contracts, you had to pay with Ethereum. I think they call it gas every time you do a transaction. And that meant that people who want to do transactions on the Ethereum network need to have at least more than zero Ethereum to be able to do different types of transactions. And the gas fees I saw when I was looking at it years gone by, and I'm sure it's not changed now, the gas fees would change according to the time of day, the volume of transactions. So, for example, when CryptoKitties came out, which was a game, but which ran on the Ethereum network, they clogged up the network so much that the gas fees became very, very high. In other words, to do a transaction on the Ethereum network, you needed a lot more Ethereum than you did the day before. And the same thing happened when OpenSea would have a brand new sale of some very exciting NFT. You know, everyone wanted this new NFT from whatever it was, some famous artist or whatever it happened to be, and the network fees, the Ethereum you'd need, the price would change. So the price of Ethereum should be and is delivered by determined by supply and demand. To say that there's a value for it, well, the value is the price, I suppose. Obviously, there's plenty of investors who just hoard it and hold it, and potentially all of that could be dumped, depressing the price. But yeah, it's so there's a utility, and a utility does translate into some sort of value.
But how would you differentiate between something which is a value which is going to increase over time and you are willing to invest long term, maybe medium to long term, with something which it's a speculation? Is there a thinking process you apply to separate these two things?
Well, when you're investing in something which delivers no income, and that could be, for example, oil, could be Bitcoin, or it could be gold. You are you're judging two things. The first thing is what is the what are the likely changes in the underlying supply and underlying demand? In other words, are we going to an economic boom where people will need more oil? Are we going to a depression where there'll be less? Has Saudi Arabia just announced that they'll be increasing their oil production? These are all factors where you've got some knowns. But the unknown, and this is where you've got to make a guess at it and have an opinion, is how are the hoarders, the people who hold this stuff, not with the intention of using it, but they just hold on to it for hoping for a higher price. How are they going to behave? What's the psychology of the human race? And that's a lot tougher to work out. I mean, I certainly wouldn't like to try and do it, but I mean, I do it, but I think that I think it's easier to say how it's going to work for gold than anything else, because I can see the factors which will drive people into gold more than I can see the factors which will drive people into Bitcoin. Well, Bitcoin, I suppose we do have the network effect. There's very few investors, hoarders of Bitcoin relative to hoarders of gold. So that provided that number of people continues to grow, as has been the case, it should be kind of supportive in a certain sense. But at the end of the workday, you've got these two factors. You've got the supply and demand, and the other factor, which is how are investors going to behave tomorrow? Could be the stock market even. If you can guess how they're going to behave, how they're going to think, what they're going to do, then you know where the price is going. That's a tough one, and that's why you've got to be diversified across all the asset classes. Because whilst you might be pretty good at knowing how the supply and demand goes, those are numbers which can be somehow figured out mostly. It's much harder to see how investors are going to behave tomorrow, because there might be something comes on television, some mad president says something crazy, and everybody goes, "Oh my God, we've elected a nutty president. Let's sell everything." And then the next day he comes along and said, "Oh, I didn't mean that. I meant the opposite." And then the stock market goes shooting up. You don't know how people are going to behave, because there's unknowns out there which are going to change their psychology. They're going to change their way of thinking.
If I wanted to complicate it further, not only just across asset classes, but even within the same asset kind. So we have physical form for gold and we have ETFs. These are clearly two different things. And the same for Bitcoin. You could have your Bitcoin in an exchange, or you could buy one of the ETFs. What is the use case? If I have €100 to invest, how to split? Why to consider both formats? Does it even matter?
There's some people who are teaching their children. I have a neighbor who's done this, how to hold Bitcoin in their own wallet where they have their own keys. And that, I think, is potentially, by the way, this happens to be a person who comes from a politically unstable country, so it might be useful for the son to have that knowledge of how to store Bitcoin in his own wallet. So holding something in your own name, whether it be an ounce of gold or Bitcoin or something which is physically in your possession, like having the physical share certificate of a company, it clearly is different from having that particular asset held on an exchange. Now, when it's in your own name, you should probably be regarding it as something you're not planning to sell, not planning to trade. You should look at it as a long-term investment, or something as a parachute, sort of like insurance, that if it doesn't work for you, you'll pass it down to your children and your grandchildren, and it'll always be there. Whereas if it's held through a vehicle like an ETF, or a stock exchange ETF or a gold fund or whatever, then you've got it held in a form where there's an extra layer of risk. That's called the counterparty risk, and and there's also the seizure risk. You don't know if some rogue government is going to come along and say, we want all the gold in the ETF because we're going onto a gold standard and we'll have to pay our bills in gold. So here you are, here's your $3,000, mate, take that, and we'll have the physical gold, thank you, because that's what we're going to pay our bills in the future. But we're not on a gold standard, so I don't see that as a risk at the moment. But you never know when you've got this extra layer of risk whether the counterparty in some way can't or won't or refuses to deliver. You might have your money in a bank, and then the sanctions come out, and suddenly you can't withdraw your money. So that's a judgment for people to make. But once you get beyond a certain amount of money, you've been saving well. There comes a point where you say, I literally can't keep it all under my pillow. That's too risky. So then you start to take your gold coins from under your pillow. You take them down to the bank's safety deposit box. But sooner or later, this is dreaming a little bit, but imagine you're doing so well. Eventually, your safety deposit box is filled up with gold and you can't hold any more. So what do you then do? Well, you still want to participate in the gold price, maybe in that circumstances. So you could now have to buy the ETF and trust that the ETF will do exactly what's written on the tin, i.e., they're willing to redeem your certificates in the ETF for gold if you present for 400 ounces, I think is typically the amount where you're allowed to exchange, or you can go in the other direction depending on whatever you want. But you're relying on the permission of your counterparty to fulfill their obligations when the time comes. And of course, if the time comes and it's a crisis moment where you physically want to withdraw your assets, you'll discover that everybody else is doing the same thing at the same time, and they won't be able to do that. We saw that with the London Bullion Exchange recently, where suddenly everybody wanted their gold in New York for various reasons, and there were tons and tons of gold trying to get from London to New York, but there were some problems like traffic jams and it was too heavy and logistical problems of all kinds, which kind of meant that it was taking weeks and weeks to get people's gold from London instead of the 2-day promise. That's the kind of problem you can encounter if you have money held by a third party. But it's, once beyond your certain level of wealth, it's a risk where really you don't have much choice. You have to do it. And to minimize the risk of your counterparty not letting you have it, you need to diversify by counterparty, lots of banks, by country, so you have lots of countries. So if one country won't deliver it to you, the next one might. And then thirdly, diversification by type of asset, because you don't know if they're going to seize. Maybe if you have a bond fund, the government defaults on those bonds and you can't get any value. If you have a gold fund, they seize the gold. If you have a fund of equities, maybe something happens in the country where your fund is, and they bring in exchange controls, and suddenly you can't withdraw any stocks because they close the fund because they can't buy and sell the shares and pay foreigners. You don't know what's going to happen. So diversify across asset classes, and then at least probably some of them survive in a total disaster scenario. And I'm not suggesting we're going to have a total disaster scenario, but at a certain level of wealth, you can't have it all under your pillow, is what I'm saying.
One other good reasons I can see is if you need to rotate something in a portfolio, because you maybe want to be exposed to the gold price, and maybe the gold has peaked, and then maybe you want to capture some of the wins and maybe put them in other part of the portfolio, which maybe are good assets but have gone down in price. Doing this with a physical form, it start to become not very practical. While if you have an ETF, it's just you click a button here and there, and then the rotation probably is done. That I see that not with the intention to redeem gold, but as long as the fund allows me to be exposed to the price dynamics, then that is doing this kind of job.
Perfect. A very good example to illustrate that would be in the area of private equity investing. Most private equity investing is done via limited partnerships run by big firms, like let's say Carlyle Group as an example. So you make a certain commitment to the limited partnership, let's say $250,000, and then they draw the money down from you over time, and they invest it in whatever they think is the best deal on the planet. That's great until the day you think they're not doing a good job and you say, I want to get rid of this. And you discover that your limited partnership, it's in your name. It can't be transferred to a bank. It's not liquid. You can't sell it to anybody else because nobody else knows what's in it. And you're stuck with it. On the other hand, I could go onto any stock exchange on the planet in America, UK, Europe, all over the world, Sweden, doesn't matter, Japan, and I can find what's called private equity funds or private or investment companies, they're often called, or they might be called investment trusts sometimes. But these companies some of them invest in private companies exactly the same way as the limited partnerships would be doing, except the stock has a quote on the stock market. And if I change my mind tomorrow about how well they're doing, I can literally sell my shares on the stock market. I might not like the price, but at least I have an option to get out if I want to. And there's a lot, in many cases, because it's quoted on the stock market, there's a lot more visibility as to what they own, because by law, they have to publish all the details to everybody on the planet, not just to their limited partners. So if I go into a private equity limited company quoted on the stock market, before I go in, I can see exactly what's in there. And even better, unlike a limited partnership, they're already fully invested. Whereas if I go into a limited partnership, they're saying, we're going to invest your money. Can't tell you what we're going to invest in it, but we're sure we're going to find some really great opportunities because we always have done it in the past. But I don't know what that will be. At least on the stock market, I get the same return as private equity returns, but up front, I know what they hold. And secondly, I've got the daily liquidity. Anytime the stock exchange is open, I can get out if I like the price.
Well, one thing with the stocks, I remember that some years ago when I bought a stock, I got a letter from the company, so saying that welcoming me and giving me a prospect and informing of the number of shares I own, etc., etc. Um, Nowadays is almost not happening at all. So I buy something, but it feels like I own nothing. Who is the owner of what finally?
Yeah. So in my lifetime, we've gone from a materialized world to a dematerialized world. When I was buying my first shares back in the 1970s, I would receive a physical piece of paper. So the way it would work back then, there was no internet or anything. You'd ring the stockbroker, you'd tell him what you want to buy. He would trust you in those days. You didn't have to have the money with him, or there's nothing like that because he wasn't a bank, so he didn't keep money. So he would buy the shares on the stock market. He would then send you a contract note, which had to be paid for within what they used to call it the account. So that was not like 3 days or one day like it is today. It was like several weeks. So you had several weeks to send a check to the broker, and then the broker, at the end of the account period, would deliver to you from the company. Well, the broker would send off the shares that he just bought to the company register of that particular company. They would register the shares in your name, send the shares certificate back to the broker, who would then send it back to you, and you'd hold the physical certificate. And then when you wanted to sell it, you'd ring the broker again, and he'd sell it, and then he'd send you a contract note and a stock transfer form. You'd sign the stock transfer form and send the certificate and the stock transfer form back to him. When he got that, he'd wait to the end of the settlement period, which was a couple of weeks, and then he'd send you a check in the post for the proceeds. That was the way it worked. So it was a materialized thing where you had a direct line of ownership in each company you bought. But now, as you say, you have a broker, he keeps your cash, he keeps your shares, nothing happens. Where's your ownership? You're not looking at a bit of paper saying this is mine. All you've got is the statement from the counterparty sitting between you and the companies saying, here's your valuation, this is what we own on your behalf. And of course, it's down to you to trust them or not trust them. If you don't trust them, you're a bit stuck.
Yeah, yeah. Let's say remaining on the portfolio. I wake up today feeling like I am a genius and I start to do research. So I'm Googling around, trying to find information, which sources can be trusted, because it doesn't matter how good my model is. If I put trash in, then it's going to be trash out. So uh, where do people find reliable information?
In my day, we of course didn't use online. We used books. And as I said, I read an awful lot of the books by famous investors and came up with lots and lots of ideas, all of which I tried at different times, and all of which collectively I try today. But you can't have the ideas from four books in one stock. It'll only represent the view of one or two of those authors. Um, but now, of course, we know that people do their research online. First of all, I think it's well worth going to reputable websites where they've done the hard work for you. For people who want to, I mean, I'm not paid by them or anything, but a website which I'm using, which I find is very simple for most people to use, because it's very quick to know if a company's good or bad in a flash of an eye. And there's a paid version and I believe a free version, which is, I think, good enough for most people on the free version. It's called simply.st, so like Simply Wall Street, so simplywall.st, and that gives you a little picture, like a green blob or red blob, with different. It's more like a snowflake with different things pointing out to how is it good value, has it got good growth, or will it have good growth? How financially sound is it? Does it pay a good dividend? And the greener the blob, and the further out towards the edges it is, the better the company is according to their assessment. I think if you only buy green blob companies, you're already on the good side. You'll find plenty of companies which is like a little red dot in the middle and they've got nothing good to say about them at all. Now, that's obviously done by computers, but it's a very good starting point because if you're looking only in the area of relatively good companies, at least you know that someone's or something has pre-vetted them, and even if you make a bad choice, it was probably still a pretty good company because it had a lot of green. I mean, one of the things I like to see on this, this is obviously just one of the tools I use. I like to see companies which are regarded as very financially sound. But it depends on the day of the week. There are other days when I say, you know what, I'm struggling to pay my bills. I need a bit more income. Let me see if I can find a high dividend stock. And there's other days where I'll say, you know what, I feel like there's a lot of money slushing around. Something in the growth sector would be good. Let me find something which is offering high growth in sales or earnings or whatever, and I'll go in that direction. Past track record is a good guide too. There's a bit on that. So that's one's website. There's also people can go to Yahoo Finance and find lots of information. Another one which I do like and I use every day is called marketscreener.com. That's maybe a bit more technical, and has maybe a bit more information than the other ones I described. Again, there's a free version and a paid version. I've taken the paid version because I want that extra information. But for people who are just starting out, that's a great place to go. On the other hand, if they're going to go to social media for their information and advice, don't forget that a lot of people on social media, when they're giving out this advice, have an agenda. Either they want to pump their own particular asset class, and well, there's nothing wrong with that. Why not say what you think is good about your asset class? But there are also a lot of people with something to sell. Real estate brokers pumping real estate, crypto guys pumping the latest hot coin that somehow they've got a load of. You've got to be a little bit wary as to what the motive is behind the person who's telling you how to invest or what to invest in. You mentioned at the beginning I'm doing my own YouTube channel. It's just started about a week ago, and it has been very successful. I think the latest video got about 30,000 views, so I was kind of surprised and pleased with that. But I'm not selling anything. I've got no product to sell. I don't sell a service. I have no service offer. I've never charged anybody for anything since I retired. And what I'm doing is engaging in education. I think the one which got a lot of views was how to spot this particular stock opportunity. It wasn't the name of a stock, it was a stock area. Is one of the most exciting opportunities that I see today and why I see it. But I was talking very generically here, not about that particular area, but more about the generality of how you spot a hot area which you should be looking at any moment in time. There's always going to be things which happen in the world which change the dynamics and throw up opportunities. For example, when Russia invaded Ukraine, lots of companies started to say, what are we going to do with our Russian assets? But they were heavily affected and badly affected by the decline in their share prices because everyone said, oh my God, this company owns Russian assets, get rid of it. So a lot of companies which are not Russian companies, but Western companies which have had interests in Russia, their prices for a short period were down heavily because of the Russian assets. And that created on its own its opportunities. I mean, I'll give you one example. There was a stock which has changed its name long since. It was called JP Morgan Russian Securities PLC. It was a unit, not a unit trust, an investment company in London who had many Russian securities in its portfolio. Had a net asset value of, I don't know, £6 or £7 or £8. It wrote the value of all the Russian ones in that down to zero, and the share price collapsed with it. But those Russian assets didn't disappear. Of course, they couldn't do anything with them. So, but for those who are minded to say, well, if I could have £7 of Russian assets for 45p, I know I can't do anything, but maybe the Russian war ends next year or the year after, and maybe they'll go back to their old price. Uh, every incident, I mean, I think Coca-Cola got hit because they had Russian interests as well, but every situation in the world creates its own set of opportunities. And that was what I was describing as generically, like the global financial crisis threw off opportunities in companies which had no debt and lots of cash because some of them had oddball businesses which people didn't like. The Asian currency crisis in 1997 created opportunities because it didn't really matter how good or safe the companies were in Asia. They went down with the indices 30%. Uh, so there's always going to be opportunities thrown up by situations. Let's say the COVID crisis. What happened in the COVID crisis? We had a very short crash, but the things which were down the most were hotel companies, airlines, hospitality companies, restaurants, entertaining, those sort of businesses. Well, where are we today? They're still all there, more or less, but you could have bought them at a fraction of the price in this crisis. So that was kind of the video I did. Got a lot of viewers, but I've got nothing to sell. So I'm doing financial education as opposed to pumping a particular asset class.
Yeah. Uh, Economy. What is your view on, and this is, I'm talking about a macro view here, uh, about the real economy, what's going on? Because if we look to stocks, everything is fine.
Yeah. Stocks often lose touch with the underlying economic situation because they're anticipating a future which they think will happen. Um, so when we've seen the greatest rallies, short-term rallies, daily or weekly rallies in history, if you look back in history and find the biggest rallies ever, you will find they come at times when the economic situation, actually looked the worst, the most dire. If we go back, for example, to in 1933, before the USA went off the gold standard. So I think it was the 5th of April they went off the gold standard. I'm talking back in January or February of that year, 1933. The crisis was so bad, the banks were ordered to be closed for a while. I think it was a 2-week closure. And businesses were going bust left, right, and center. It was the middle of the Great Depression. When the banks reopened, stock markets had, in the USA, the US stock market, had its biggest one-day jump in all of history. I think it was 13% on the day or something like that. And it then went on in the next few months to be up 100%. Now, how could that be happening in the middle of the Great Depression when businesses were going bust left, right, and center? And it was one of the biggest crises ever. Well, maybe some people with a lot of foresight foresaw, I don't think they did, but who knows? The stock market's very looking into the future. Maybe they saw, looking into the future, that America was going to go off the gold standard, and that would mean that they could reflate the economy with paper money. Did they see it? I don't know. I don't know how people thought at the time, but whatever they saw before that happened, and it was only weeks or months before it happened, it caused the stock market to rally massively. And if we go back, the COVID crisis, start right at the start of the COVID crisis, as an example, it was March 2021, I believe. Stock markets crashed heavily, and everybody said, "Oh my God, it's the end of the world. What can I sell to raise cash because we've got to be safe?" That proved to be the bottom, and then we had this massive rally, which never looked back again. And the same thing could be said to the 1987 crash, to the 1997 Asian currency crisis. There were some where the crashes lasted a long time, like the bursting of the dot-com bubble. Well, that was, at least as far as technology stocks were concerned, that lasted for 3 years. But you'd have been just fine if you'd bought into banks and utilities back then. They were going up when everything else was going down. So there's always, in a situation, there's always going to be your opportunities to find something which, if you look carefully and try and figure it out, should do well in the future when things normalize again.
Or not. Yeah.
So
Uh,
yeah, economic noise. We have this news every day. We're submerged by it and we react to it. And everybody else on the planet has heard the same news as you, and everybody on the planet is likely to act in the same way as you. So what does that mean? It means you're part of the crowd. You're doing what everybody else is doing. You're running like the lemmings, and that's something which I've learned to avoid. Obviously, one of the ways to avoid it is by not having so much in anything that it scares me. If it goes down 20, 30%, it's all right. It's a good business. It pays its dividends. That's why I bought it. I bought it because I want a 3% dividend. Okay, it's half price now. Oh, it's a 6% dividend. Well, that's fine. Um, 6% of half the price, but it's still the same dividend as I was getting before. The business is still robust. It's not going to go bust. It's just that people are now running scared. Should I be running scared as well and selling it at half the price I paid for it? No, it doesn't make any sense. But this is the stock market for you. It's unlike the shops where people go to the shops when the sale is on, things are cheap. In the stock market, they rush to the stock market when things are expensive and going up, and they run away from the stock market when things are cheap and going down. It's very contrarian, and you've got to try and turn your mind around and think the opposite way.
but now, if I if I look deep enough, then I see a lot of news about companies going bankrupt, and or even big companies losing a lot of their business. And at the moment, it seems like Big Brother is just pumping money to somehow compensate. But how long can it go? And what I see is that at the moment, we are at all-time high almost in everything, like all-time high in stocks, all-time high in debt, all-time high in social help from government. It looks like, I don't know the time, but it's like when you play Jenga and then you are getting close to the end, and then maybe the next move still okay, but tomorrow might collapse. And what risk does it really put into the game of building the wealth, selecting stocks, creating your own portfolio, and which noise must be filtered? What do you think about this? It is a big topic, but uh,
You mentioned bankruptcies, more bankruptcies than before, and obviously many companies reporting lower profits than before or lower expectations for the future. Um, this obviously, to my mind, means that it seems more than likely, more than 50% probability that stocks will go lower. But I'm also aware that stocks could defy gravity for very, very long periods of time. 1994 was a time when stocks seemed to be rather elevated and the situation of the economy didn't seem that good. And yet we saw a 6 or 7 year bull market, the biggest in all of history, which followed it, despite the seemingly overpriced levels of 1994. So you've got to be aware that things don't always behave in the obvious way. And I'm not suggesting we're in 1994 or anything like that today. I would say the balance of probability is stocks go down, but you have to be prepared for the possibility that it doesn't happen. And instead of stocks going down, profits recover. And there's several reasons to think that might be a possibility. First of all companies are headed up by highly paid, highly skilled boards of directors. And that's not universal, by the way. It depends, but you'd like to think that with their huge salaries, these boards of directors have the skill set to navigate the woes of this world. If it's tariffs this week, of course, that is the big topic at the moment. You'd like to think that the people at the top of the pile are having lots of consultations with experts and discussions between themselves as how they can navigate that particular crisis of something which is going to eat into their profits. What can we do? And they'll be coming up with ideas and solutions, and that's what you're paying them for. So first of all, that's the first thing. You could expect the boards of directors to do everything in their power to lose the least or still grow despite all the woes which are being thrown at them. And the second thing is, where are we going if, well, let's just cut that. Let's say some of these companies do fail along the way. Well, the demand for whatever they were selling is probably going to go to a competitor. So if you've got two companies, let's say, selling, give you an example, movies, a good example, I wouldn't say name any companies, but let's say two movie streaming companies, and one of them goes bust. What's going to happen? The subscribers to that movie company are going to say, okay, that one doesn't work. Where shall we go? And they're going to look around at the others and choose one of the others. And they'll probably subscribe to that. So the business which is lost by one tends to go to another one. So if you own a portfolio which is diversified, uh, for every loser, there's probably a winner. And then the bigger thing I was going to talk about is what you talked about at the end, which is debt and where does this go? Um, and we're talking here about the level of government debt. I think that's what you meant.
Yeah.
We're in a world where that debt cannot be repaid. There's no chance. There's nothing which can be done. No amount of adjusting the budgets and so forth, which will allow that debt to be repaid. So if it cannot be repaid, the only thing they can hope for is to keep borrowing from Peter to pay Paul. And when that fails, if they can't borrow from Peter to pay Paul because Peter says, sorry, I won't lend you any more to the government, then their plan B will be to monetize that debt by allowing the central bank to buy the debt by printing money. And at that point, a lot of money comes into existence. And when the central bank pivots and the money comes into existence, we have the mother of all rallies in everything from gold to Bitcoin to stocks. It doesn't matter. Everything's going to go through the roof because suddenly the bank has gone into the central bank has gone into quantitative easing again, and that means asset prices will go up. And yeah, so but before we actually get there, it's quite likely that some asset classes will be anticipating this because they say this is the only way out. It's the only thing which can happen. There is no other solution. So before we get there, these asset classes, that would be gold, for example, or stocks, will be anticipating what's going to happen, and they'll be rising in anticipation of this quantitative easing, which is going to come down the line.
But okay, so if default is not on the table, then high inflation then is the only way forward. Uh,
Oh, there are other ways forward.
uh, so if that is the trajectory, then everything will go high in price. So it feels like if you look at this and you say, well, the debt can never be paid. At least the bigger economies, small countries might default, but the bigger economies will not maybe default. Then the only way is inflation. Then my problem is solved. Just close your eyes and throw some money around on companies because it will anyway go up. What is the problem with this process thinking?
Well, first of all, your way of thinking is very plausible and also, I would say, very likely. But we have to be aware that there are some other things which could happen, which could make that, I say make that, uh, which might seem not to be such a good deal, um, but you'll still come out the other side alive. One of the scenarios we've encountered historically, well, there's several, but one of them has been what's known as exchange controls, where governments limit what you can do with your money. Even in America, they had a sort of exchange control from 1930s through to the 1970s, which basically said it is illegal to export or transport gold. You couldn't do anything with it. You couldn't take it abroad. You couldn't buy it from abroad. You couldn't do anything. So in America, but European countries had a lot more exchange controls than America did. I remember back in the 1970s in Great Britain, if you wanted to go abroad on holiday, you had to have the back of your passport stamped with the amount you were allowed to take. So in the early years, it was £50 for one trip, and then they raised it a bit. Eventually, it became £150 you could take abroad, and that was it. You couldn't take any more money out abroad, and you couldn't earn foreign currency, and you couldn't take gold. So you were very, very limited if you went abroad, because okay, it could still buy you some sort of holiday, but it wasn't. You couldn't take your money and go and buy South African shares or American shares. It just wasn't legally possible back then. They abolished exchange controls in the 1970s anyway, which was good news because it meant that the world could start to invest freely. But before they did that, we effectively had two levels of the pound. It wasn't like a black market system. They called it the dollar premium, but the dollar premium basically said if you are a foreign investor investing in the UK, we'll give you more pounds than the official exchange rate. And if you're a company in the UK paying for something overseas, we'll give you only the official exchange rate, which is much worse. You'll be worse off. So to illustrate how that could work in certain cases, my mother, she was a freelancer, but she worked for as a stenotypist, where you type out the notes at courts and things. And she'd get invited to Geneva, where I am now, to attend conferences by the international organizations and type out the notes. So you do it on a stenotype, and then you go back home and you translate it back into English. Obviously, stenotyping is unreadable by most people, even though it's technically English. But you go back and read this reel of, it's like a ticker tape. Read this reel of ticker tape and translate it into words on a typewriter. But she was paid an allowance when in Switzerland in Swiss francs, which she had to, by law, convert, if she had anything left, into British pounds at the official exchange rate. But you could walk freely into a Swiss bank and get far more pounds for your allowance than you could if you changed it when you got back to England at the official exchange rate. So she would sort of like go into if she had a little bit of money, she'd go into a Swiss bank, change it into a £5 note. So it'd be like I don't know what the exchange rate was then, but maybe it was 14 Swiss francs to the pound back then. It's now nearly about one to one nearly. But she'd change her 14 Swiss francs for a £1 note, or maybe 5 times that for a £5 note. And then she'd pop it into an envelope and write a letter to her mother and say, "Dear Mum, here's the £5 I owe you," and send it back. And it was a way of getting money into England slightly without following the rules. Obviously, it seems like nothing today, but that's the point. There were two exchange rates. One you could get abroad and one you could get in England. And that was called exchange controls. And we might get into a world where we have exchange controls. So your freedom to invest in things that you wanted to invest in will go away. Another system which has existed and also existed in the UK at various points in time, particularly after the war, is called ration coupons. After the war, things were in short supply. Butter, meat, milk, sugar, you name it. So the government, to try and help things, nationalised some companies like the Tate and Lyle, the big sugar company, was nationalised and so on. But if you wanted to buy, let's say, a pound of butter, you could only buy it if you had a ration coupon to go with your money. So it didn't matter whether you were rich or poor, you were only allowed, let's say, a pound of butter a week. So without that ration coupon, your money couldn't buy the butter. So what was the real money? Was it the ration coupon or was it your pound note? Well, clearly, if there was obviously some trading, illegal trading, I suppose, going on in the ration coupons, where some people wanted more of something and would buy them on the black market from other people, to some extent, I imagine. I wasn't actually watching this because I was a child at the time, but you can imagine the real money then was, for certain things anyway, that you wanted to buy, was the ration coupon. So what happens when we get the CBDC? Is the CBDC going to be our ration coupon? And you suddenly find you can't deploy your old money, even though the exchange rate's 1 to 1, you can't deploy it into CBDC because you've got a limit. They say, sorry, the maximum you can put in your CBDC wallet is this, and only in these circumstances. And by the way, your CBDC wallet is limited to what you can do. You can't speculate against the dollar, or you can't buy gold, or you can't do this, or you can't get on an airplane more than 5 times a year, or you can't buy more than £2 of meat per person per week. Now, who knows what the rules will be? But the CBDC could be the equivalent of the dual currency. So we end up in America or UK or France or Switzerland with a dual currency system where you've got two types of currency, one that you can spend and the other one, which is a legacy currency, which you can't actually do what you want with it. So it's worth less, even though it's 1 to 1 officially, but 1 to 1, except you're not allowed to change it. So that could be another way that they solve the debt problem because they basically make the economy operate on the new currency, the CBDC, the central bank digital currency, which is coming, and the old currency starts to die away because its utility starts to become more and more restricted. On day one, it's the same thing. It's one to one. You can do whatever you like with both. But later on, they say, well, sorry, you can't now speculate against the dollar, or you've got to buy all your food through your wallet, or anything. If you do this type of transaction, it's got to be through your wallet. If you're buying a house, you've got to do it through your CBDC wallet at your bank. And by the way, you can't change more than $1 million for that purpose. Whatever you can imagine, all kinds of rules might come in, which allow the government to leave behind its old debt in a currency which is going out of use. And suddenly you get to a day when you can't deploy your currency and it's worth tuppence halfpenny.
But with the Russian coupons, they create some sort of secondary market, I would say.
Yeah.
CBDC with risks would be like Russian coupons, which do not allow people to create that secondary market. So, because the money is programmable, basically. So, and it can, while the Russian coupon was a physical note, maybe you can give it to the other person. Here, you can't transfer from outside your wallet. And black market is simply a manifestation of natural human needs. But in this case, and maybe that black market was like the escape path. Like we support everything, but there is something is leaking. There is an escape, so the pressure is kind of released and then it goes on. If we are in this condition where the pressure can't be released, do you see a risk that CBDC might not fulfill the objectives because, let's say, the physics behind is not backing it up?
Well, for sure, when the central bank digital currency comes in, it is absolutely programmable. So every transaction you carry out, whether you're making a gift to your granddaughter for her birthday, or buying some vegetables in the shop, or buying some stocks on the stock exchange, they will know, and they will be capable of knowing as it becomes more and more programmable. I mean, it will be programmable. The question is, to what extent are they knowing it and monitoring it on day one? I think to start with, they'll just say, we're not doing this because we respect everybody's freedom and rights. But if you're spending more than €1,000, and this will be the case in Europe, we need to know just to make sure you're not money laundering. We want to make sure you're not a tax evader, and we want to make sure you're not a terrorist. So all transactions over €1,000 have to be via your CBDC wallet. That's going to be the law, and you've got no choice about it. You can't, even though cash at the time might be running in parallel because it's not yet law that that's the only way of doing your transactions. Anything more than 1,000 has to be by CBDC, so we can monitor it and check on you. And later on they'll say that there are certain controls for other reasons, perfectly valid reasons. Obviously, if we think you're a drug dealer or a terrorist or whatever, we can freeze your wallet or stop you using it or bring in some sort of controls. But what about if you're on Social Security and we're giving you an allowance so you can feed your children? Well, is it reasonable that they should then say, sorry, but the money you've got in your CBD wallet will be the same and equivalent to the food stamps in America, where you're only allowed to spend it on food and you can't spend it on alcohol or gambling or other things? Well, some people say that's perfectly reasonable. If someone's giving you money, they've got social security. They've got every right to tell you how you spend it. Some people would say that. Some people say, no, it's an infringement of my liberty. It's my right to get my free money from the government. I don't have to do anything for it. And the fact I exist entitles me to it. That's how some people think. But there's certainly some people who would say, probably the hardworking, who say if you get something for nothing, the person who's giving it to you should have the right to tell you what you do with it. Just like if you give money to a charity, you've got a reasonable expectation they'll spend it in the way you're telling them. But of course, being able to control how people are spending their social security money on things, then the next step might be to say, well, we don't think people should be polluting the planet too much by taking too many aeroplanes. So we'll limit how many flights you can book. Oh, and we just discovered actually you turned up at the last demonstration against the government, and because you turned up against the demonstration against the government, we're going to limit your ability to get on a train because you won't be able to buy a ticket to a town centre whenever a demonstration is a risk. And now you suddenly find your travel abilities limited. And then they might go further and say, well, you're voting for the wrong political party. So, or you made a post on social media that we didn't like. And now we're going to restrict your ability to do something via your CBDC wallet. So it will become, I think, and I don't fear for myself because I have none of these bad things. But I fear for my children, my grandchildren, my great grandchildren, who I think will probably find themselves living in a very dystopian world because of this ability to control how people behave and what they do through their CBDC wallet.
I wanted to touch as well on tariffs because it's very trendy nowadays. And the opinions around are mainly that tariffs are not good and this is a big mistake and trade. Now I can find some areas where I can see tariffs, I can justify them, but what will be the effect of this long
Well,
term? Or it is
well,
just a short game and the tariffs is like the bait and the real agenda is something else.
well, first of all, every country has the right. I mean, putting the general agreement on tariffs and trade to one side, and let's assume that agreement doesn't exist. But every country has the right to put whatever tariffs it likes on either imports or exports or both. That's their right. It's their economy. They can do what they like. Is it good for the economy? Well, economics says, in general, it's not particularly good for the economy because it forces resources to go to places which are less efficient. It might be very efficient for Canada to make socks and inefficient to make shoes, and it might be very efficient for America to make shoes but not socks. If you have no tariffs, all the shoes will be made in America and all the socks will be made in Canada. But the minute you bring in tariffs, you force half the shoes and half the socks to be made in Canada, where that means 50% of it's inefficient production. And the same thing on the other side of the border in America, they have to make half shoes and half socks. Again, you've got half of that, something which the Americans are not good at, where it's all going to be very, very inefficient production. So resources don't go to the most efficient places, and it means that it means that people will suffer due to effectively paying higher prices or having less goods and services than they would have had if things were made and manufactured in the most efficient places. That's why we had the General Agreement on Tariffs and Trades in the first place, to get rid of all these barriers so countries could trade with each other completely freely. And of course, I think we've also got to distinguish between a tariff and a value-added tax or a sales tax. Now, many countries do have what's called a sales tax or a value-added tax, VAT. Then it's only reasonable if you have an internal VAT which applies to domestic goods. It's only reasonable that that should also apply to goods which are imported. So when goods are imported, they should pay the same. If you're imposing a VAT or sales tax on local goods, you shouldn't. It doesn't make sense to give an advantage to foreign goods by not charging them to that. So that kind of makes sense as well. But at the end of the day, tariffs are not going to be particularly good for world trade. And what we will get if we have a severe change in tariffs, as has been proposed, is severe shocks in different places and probably in lots of places we don't expect. And let's take the USA, where they're imposing the tariffs in the first place. There must be many companies in the Americas, in the United States, who rely on components which are imported from abroad, and they just carry out the final step in America, maybe putting it in a box, for example. And the question is, when is it a component or when is it a finished product? There's degrees from 0 to 100%. that's hard to determine how finished it is. And of course, if there is a rule saying if it's 99% finished, it's a finished product and therefore it's subject to tariff. And if it's only 1% finished, it's just a widget coming in. It's not. But where do you draw the line? And companies will adjust. Smart directors will adjust to that anyway over time. But it takes time. If you don't know what the rule is going to be tomorrow, you're not going to make any changes until you're sure that you know where the rules are and how they're going to be. So there won't be quite the effect that's hoped for in terms of suddenly all manufacturing returning to America in one fell swoop. It will take a long, long time, and it'll also take a great deal of certainty because people aren't sure whether those tariffs will still be in place in 3 years' time. I mean, they're not even sure if it's going to be in place next month, let alone tomorrow. We don't know, and that you need to know before you make commitments to building factories and things. So I don't think it's going to be. I don't think the tariffs are going to achieve the hoped for return of manufacturing to the United States. At least not very quickly. It might. It won't be the present president who will benefit from that if it does happen. And I obviously it's not doing any good for the American public who will immediately have to pay more for their goods. It's not doing any good for the American importers who are having to bring in lots of components to build their American products because they're going to have to put their prices up. They're going to sell less. They'll have less turnover and probably less profits due to that. And it's not good for the exporters around the world who have been manufacturing cheap goods because of cheap labor, perhaps, or maybe because of a low exchange rate. It's not going to do them any good because suddenly they're going to find 10 or 15% of what they export drops from that 10% to maybe 7 or 6% because they won't be exporting quite as much to America. Then to some extent, they'll be able to substitute where they export to. Let's say a German car manufacturer sold a lot of cars into America. Well, now it will sell less cars into America. It will still sell some, but it will probably be able to sell more cars into other countries, albeit not at the same price, and therefore their sales will go down a little, and their profits will go down a little because of the lower price.
So I can look at the tariffs and analyze them in two different ways. One could be a political reason, the other economics. And when I think to the economy, I am reminded of free trade. So I trade with you because at the end of the trade, there is a win-win. I am better and you are better. But if you were very good in doing product A and I'm very good in doing product B, and if you would do product B, you would end up having much more cost, for example, so because not efficient. But then let's say now Big Brother comes to you and subsidizes you. So suddenly you start making, you were making A, but now you start to make B. And not because you are efficient, but because there is some hands coming around and then making it happen. Now, is this a case where tariffs can be justified? Because one side initially will be destroyed, and if we were the only two partners in this economy of two people, let's say, then it will destroy me first, and then maybe later on it will destroy as well you from a trade perspective. Do tariffs make sense in this case? Are they justified?
Well, historically and in today's world, any level of tariff from one country to the next doesn't make sense for either side. And in the old world, when we were on the gold standard, gold would move, which would effectively adjust the level of trade anyway and adjust the exchange rates between the two countries. There's obviously things changing in the world which might disrupt that conventional wisdom. And what I'm thinking of here is the speed at which artificial intelligence is going to change everything, including the manufacturing process going forwards. So we don't know for sure where that leads, but there's certainly going to be a lot more efficiency everywhere. And it might mean that companies which previously could produce very cheaply because of their low labor costs are now facing competition from even lower labor costs because the labor now is machines in a different country, because those machines will be able to do things that only humans could do in the past. So it's too early for me to judge and say it's absolutely a bad thing. But obviously, by conventional wisdom, tariffs are a bad thing. I mean, for me, the way forward with tariffs, if you want to put them on, is to go very slowly but surely. And I think it would have been a better bet if instead of announcing very, very high tariffs, if the president had said at the very beginning, very sorry, but we have to raise a bit of revenue. We're not blaming you guys for selling us cheap products or blaming the American citizens for choosing to buy foreign goods because they were cheaper. But we have to raise tariffs because we need to raise some revenue. So we're going to sadly put a 10% tariff on everybody, and it's going to be fair. It's going to be fair all round, and we'll have a sales tax of 10% in America as well to help. That, of course, it will boost prices a little bit, but this is a crisis with the debt, and everyone has got to understand that in a crisis situation you have to make some sacrifices, and that's what we're doing. But to leap in and say the tariffs will be 20, 30, 40, 50%. It's moving too fast, I think. So if they went for the 10% tariff outright at the start, then it would leave some flexibility open over time to increase those tariffs. But I think it's also a dangerous game to play to have what's called a tariff war along the lines of we're going to tax you higher than you because you've done this or that or the other. That should be the subject of a separate set of negotiations, not of saber waving.
Okay. So I think we are coming close to the end of our episode together. And before finishing this, I had one point of the agenda, which is maybe if we can give to the viewers like few rules, basic things for them to feel comfortable, as they approach investing, especially in stocks. What are the few things you tell to people, regardless of their educational background?
Well, my first advice would be if you can, and by can I mean you know how to read, then educate yourself as much as you can about the alternatives to leaving your money under the pillow or in a bank. And by that I mean learn about investing. If you're a young person, you could afford to take bigger risks than an older person, because if you take bigger risks and lose it all, you still have the rest of your life and career to make it back and have another go. So I have a very simple rule. I say that the number of investments that you should own is your age minus 20. So if you happen to be 21 years old, it's fine to own one investment about which you are very committed, you're absolutely sure. But if you're 30 years old, you should have at least 10. And if you're 40, at least 20, and 50, at least 30, and 60, at least 40, and so on. So by the time you retire at 65, it would be good to have at least 45 different investments. And that's not just equities. It could be different types of things. It could be gold, silver, commodities fund, structured product, equities, it could have 20, 30 equities in that portfolio as well. So according to your age, diversify as you get older. Look for opportunities, I'd say. Ask yourself at any moment in time, what is changing in the world? And if there's something changing, that's probably throwing up opportunities. I'll illustrate one related to the tariffs. I'm not going to say names because I don't want to be a stock pumper or anything, but I went looking for companies which are net beneficiaries of the tariffs. There are some out there, and these are the types of companies which help other companies manage their supply chains, manage their infrastructure, manage their locations. So, for example, if a country wants to move its manufacturing from country A to country B, or wants to change the mix of goods from they want to send more finished goods or less finished goods from one country to another country. There are companies which specialize in that sort of area. who could be net beneficiaries of the tariff shock. If we have a pandemic, well, we know which companies are going to be down. It's going to be all the hotels, cruise liners, shopping malls, and everything like that. If we have a war, the aggressor will find its heavy sanctions against it, but anyone who happens to have an exposure to that country will find their share price down with it. So each situation. So look out for opportunities when we have a situation. Ask yourself, what is the situation today? So one of the situations we have today is the gold price is going up because central banks don't trust US treasuries anymore, or not as much, and they're diversifying as fast as they can. And in the process of diversifying, one of the things they're diversifying into is gold, so it's very well underwritten by that. But who's the beneficiary? Well, obviously, it's the gold mining sector. You've got to look, obviously, it doesn't mean buy without thinking about it. You've got to look at what you're buying and buy the right sort of companies. And I've got my ideas about what the right sort of companies are. I'm not talking about names, I'm talking about types of companies. They're kind of companies which are going to be able to dig the gold out of the ground and sell it at that higher price. Because there's some companies who've got the gold but can't dig it out because they haven't got the money. But you've got the idea. Look for the opportunities according to the situation we're in. So ask yourself, what situation are we in? Who is the net beneficiary of that particular situation? And then you'll find some real opportunities if you're willing to do the homework.
Clive, many thanks for your time. Long interview, but with a lot of information, I think, for the viewers.
Well,
If
thank you
anybody
very
wants,
much, Elvis.
if someone want to contact you or want to look at your content, where to find you?
I've got nothing to sell and no services to offer. I don't get paid by anybody for anything. So I'm only on LinkedIn where I write articles about what's going on in the financial world 2 or 3 times a week. And I do allow people to write to me. I'll accept your invitation if you have a question relating to investments or finance. I don't give out specific investment advice, but I'll certainly help you see if you're on the right track with what your thinking is, and maybe point you in the right direction if it's not the way I would think. And I can't give career advice. I get a lot of people every week writing to me saying, I want to become a private banker. What do you recommend? Or I want to become an investment advisor. That's not my cup of tea. I mean, of course, I could give advice on that, but really, I think there's many other people who could give better advice than me because I don't actually like the advice I'd give. If you said to me, how do I want to become an investment advisor? I'd say, well, run with the crowd, stay in the middle of the pack. Don't stick your neck out. Don't have your own ideas. Make your decisions by committee so you can blame somebody else. Always follow the house view. All good advice to keep your job, but terrible advice for your investors. So I just can't consciously, in my own conscience, tell people to do that type of thing. So I don't give career advice, but I will give you advice on investment. Not advice, but I'll give you guidance as to whether you're thinking the right way. If you have questions about investments, your grandmother's died, left you a house, and you want to know what are the pros and cons of renting it out or selling it, happy to have a discussion about it.
Okay, okay. So, okay, then I think we are the end of the episode. Again, many thanks.